Hi students, O-Levels Online presents the video lecture, Series 4, Other Adjustments of Financial Statements. In this video, we will discuss the topic, the effect of errors on profit. This video series is helpful for those students who are appearing in Cambridge O-Level upcoming exams, either in June or November, through CAIE or IGCSE or IGCSE, 9-1. For accounting, 7707, or 0452, or 0985. Let's begin the lesson material. In this slide, we will discuss the effect of errors on profit. Errors in accounting records can significantly affect a company's reported profits on the income statement. These errors often arise due to incorrect recording, omission of transactions, or misclassification of items, leading to either an overstatement or understatement of profit. Let's break down how these errors can impact profit on the next slide. Profit will be overstated when errors lead to the understatement of expenses or overstatement of revenue. In this scenario, the reported profit will be higher than the actual profit. Let's check the causes of it. Here we will check the causes of overstated profit due to errors. The first cause is omitted expenses. If expenses such as rent, wages, or utilities are not recorded, the profit will appear higher than it actually is. For example, if a business fails to record $5,000 in rent expenses, profit will be overstated by $5,000. The second cause is understated expenses. If a business understates an expense, the overall expenses will be lower, and profit will be overstated. For example, recording $1,000 expense instead of $2,000 will impact on profit and it will be reported on higher side. The third cause is overstated revenue. If revenue is recorded incorrectly, the profit will be inflated by the difference. For example, incorrectly recording additional sales of $2,000 when they did not occur will overstate profits by the same amount. Let's check the impact of overstatement of the profit on the financial statements too. First, we will check the impact of overstatement of profit on the income statement. Profits will appear higher than they should be, misleading stakeholders. Secondly, on the balance sheet, retained earnings will also be inflated due to the overstatement of profits. Let's check the understatement of profit due to errors scenario. Profit will be understated when errors result in the overstatement of expenses or understatement of revenue. In this case, the reported profit will be lower than the actual profit. Let's check its causes too. Here we will check the causes of understated profit due to errors. The first cause is overstated expenses. If expenses are recorded at a higher amount than they should be, profits will be lower. For example, recording $12,000 for an electricity bill when it was only $8,000 will result in an understatement of profit by $4,000. The second cause is omitted revenue. If sales or income are not recorded, profits will be lower than they should be. For example, failing to record $5,000 of sales will understate profit by that amount. The third cause is understated revenue. Recording less revenue than what was actually earned will reduce reported profits. Let's check the impact of understatement of profit on the financial statements too. First, we will check the impact of overstatement of profit on the income statement. Profit is understated, giving a false impression of lower profitability. Secondly, on the balance sheet, retained earnings and possibly the assets will be understated. Let's check the errors which do not affect the profit. Some accounting errors do not affect profit calculations because they do not impact the income statement, which includes revenues and expenses. These errors usually occur in the balance sheet accounts, such as assets, liabilities, or equity, without altering the revenue or expense figures. These are commonly referred to as errors that do not affect the trial balance. Here are some errors. Number 1, error or principle. These errors occur when a transaction is recorded in the wrong type of account. For example, an expense is recorded as an asset. Although the transaction is incorrectly classified, it doesn't impact profit directly, because it does not affect the revenue or expense accounts. Number 2, errors of omission. These occur when a transaction is completely left out from the books of accounts. Since both the debit and credit sides are omitted, the error does not affect profit calculations, as no revenue or expense has been recognized. Number 3, errors of commission. These are errors where the correct amount is recorded, but in the wrong person's account, or in the wrong account of the same type. This affects individual accounts, but does not change the overall totals, so profit remains unaffected. Number 4, compensating errors. These occur when two or more errors cancel each other out. For instance, one error overstates an amount, and another error understates it by the same amount. The overall financial result remains unaffected, including the profit. Number 5, errors in posting to the wrong side of accounts. These happen when an entry is posted to the wrong side of a balance sheet account. If the error affects only asset or liability accounts and does not involve revenue or expenses, profit will remain unaffected. Number 6, transposition errors in non-revenue or expense accounts. A transposition error occurs when digits of a number are reversed. If this error happens in accounts that do not involve income or expense accounts, for example, assets, liabilities, profit will not be affected. Let's check the errors which affect the profit. Errors that affect profit calculations are those that directly impact the income statement, specifically the revenue and expense accounts. These errors can lead to either an overstatement or understatement of profit, which can distort the financial performance of a business. Here are the types of errors that affect profit calculations. Number 1, errors of omission or affecting revenue or expenses. These occur when a transaction involving revenue or expenses is completely left out of the accounting records. When either revenue is omitted or expenses are not recorded, it directly impacts profit. Number 2, errors of commission or involving revenue or expenses. These happen when the correct amount is recorded, but in the wrong account. If the error involves revenue or expense accounts, it will affect profit. Number 3, errors of principal or affecting revenue or expenses. These errors occur when a transaction is recorded in the wrong type of account, or recording an expense as an asset. If the error involves a revenue or expense account, it will affect profit. Number 4, errors of transposition or affecting revenue or expenses. These errors occur when digits in a figure are reversed, affecting the amount recorded. If the error occurs in revenue or expense accounts, it directly affects profit. Number 5, errors in recording adjustments. At the end of the accounting period, adjustments are made for items like depreciation, accrued expenses, and prepaid expenses. Errors in these adjustments will affect profit. Let's check other errors too. Number 6, errors in double entry or affecting revenue or expenses. If an error is made in recording one side of a transaction that involves a revenue or expense account, it will affect the profit calculation. Number 7, errors in accruals and prepayments. Accruals or expenses incurred, but not yet paid, and prepayments or expenses paid in advance, must be adjusted at the end of the period. Failing to adjust for these items will affect profit. Number 8, errors in revenue recognition. Revenue recognition errors occur when revenue is recorded in the wrong period, or not recorded at all, affecting profit. Number 9, errors in inventory valuation. Inventory errors affect the cost of goods sold, which in turn affects profit. If inventory is overvalued, COGS is understated, and profit is overstated. If inventory is undervalued, COGS is overstated, and profit is understated. Let's move to another slide. Positively, you got the clear understanding of the effect of errors on the profit, as per your syllabus and examination point of view. If you have any query regarding the lesson, kindly ask in the comment section of this video. We will discuss the next topic, the introduction of accounting ratios, in the upcoming video. You can download the related formats and lesson material through the link provided below. Thank you for watching. I hope you learned something new today. If you did, like and share video with other people to learn from it. And please subscribe my channel if you want to see more videos like this. Take care of yourselves. I'll see you in the next lesson. Goodbye.